Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of which relied upon as any form of personal advice. FP Markets does not know your personal scenario, nor your personal financial goals, and therefore none of which relied upon as any form of advice at all. It's just general in nature only. Slight signs, ever so slight signs that maybe the market is now turning. There is no doubt that the market is now pricing in the idea of recession as a near certainty, because we've just seen a confirmation from the final first quarter GDP read of a contraction of 1.6%. And then you look at the Fed Atlanta president's numbers that show on their GDPNow that the second quarter could actually be contracting by about 2.1%. That in economics is a technical recession, and that is there. It is the speed of reversal that is absolutely fascinating. Have a look at the US 2-year. It has dropped 60 basis points from its peak in June to where we are now. The 10-year is 1 basis point behind it, down 59 basis points. And then you look at the expectations around rates from 2022 to 2023. The turnaround in terms of, if you have a look at the XP1 and XP2 comparisons, they are declining at the fastest rates that we've basically ever seen in living memory. And that is fascinating because it means the market is now at the point of view that the inflation chase possibly will be abandoned because the whole issue around economic growth is now coming to the fore. There are also ever so slight signs that inflation may have peaked in the US as well, and it's starting to possibly ease off. The household sentiment at the moment is absolutely crashing, and that in itself shows you that demand-led inflation is going to slow down. There's also enough signs that maybe supply is finally starting to come back and easing pressure on that inflation price as well. All of those putting together, though, suggest that maybe the Fed could go all the way through 2022 and then ease next year. That doesn't mean, though, that it's changing anything in the US dollar, and it remains the place to be in the G10. But there are parts that we need to look at. Have a look at dollar yen. It has eased away from those decade highs that we've been seeing, but still at 135, it's incredibly high. But real rates are starting to shift. Watch that pair quite closely. But then you've got to look and also remember that what's going on in the UK and Europe is absolutely dire. Cable at the moment is at a level that you just cannot believe. It is now testing 119 easily. And there is no doubt if we continue on the current path and what the BOE is forecasting, cable could well and truly be on track to 115 by the end of the year. You look at euro dollar, 103. That is an incredible level to be seeing in that pair as well. And again, this is despite the fact that Christine Lagarde is now putting her hand up and saying, yep, we're going to have to raise rates too. It just shows you how weak risk currency is and how weak the overall economic position is in the European area. It's different outside of there. You look at the CAD, you look at Aussie, and you look at the Kiwi. They're under pressure, no doubt, but not the kind of pressure we're seeing in those two in particular. And that is where we think we need to keep watching. Keep an eye on what goes on with the battle through the Atlantic, because at the moment the USD is winning and probably will continue to do so in the near future.